Welcome to Sheen Research, your strategic partner in comprehensive investment analysis. So today we are ripping into the latest numbers from Conagra Brands, Inc., that's ticker CAG, to really understand their performance for the first quarter of fiscal year 2026. And this isn't just about, reading a press release. We have combed through the very dense 10Q filing. We've dissected the nuances of the earnings call transcript.
Yeah, and there were a lot of them.
A lot of them.
Yeah.
And we've absorbed the critical investor commentary, all to give you a clear, quantitative, and strategic picture of where this massive consumer staples company stands for the 13 weeks ended August 24, 2025.
And our mission today is, I think, really crucial because this specific quarter presents a notoriously complex data set. It's an intricate puzzle.
That's a good way to put it.
It's filled with significant divestitures, some really volatile one-time tax adjustments, and these persistent, just crushing inflation pressures. So we are tasked with cutting through all of that accounting noise.
Right.
We need to capture every numerical fact and, I think more importantly, synthesize the context behind those figures, especially how management is strategically navigating this really turbulent environment by making some very deliberate trade-offs.
Okay, so let's start with the top-level results, because if you just look at the headlines, you would walk away completely confused.
What?
I mean, completely.
Oh, absolutely.
CAG reported net sales of $2.63 billion for Q1 FY2026. Now, that is a noticeable 5.8% decline year over year from the $2.79 billion they reported in the prior year period. So that's the bad news.
That's the headline number that looks bad, yeah.
Exactly. However, the adjusted diluted EPS came in at 39 cents, which is actually a tactical win. It beat analyst estimates by a full 6 cents.
And that strategic victory is key, but we have to frame it correctly. I mean, that adjusted EPS figure of 39 cents, while it beat the estimates, it still represents a steep decline.
A really steep one.
Yeah, a 26.4% decline when you compare it to the prior year's implied adjusted EPS of, 53 cents. So the bottom line is clearly under pressure. Right. What's fascinating here, though, is the market's reaction. The stock was rewarded. It posted a significant 5% upside on the earnings day.
Which is so counterintuitive when you hear sales down, earnings down.
It is, and it suggests that the street was focused squarely on that adjusted earnings beat, the strategic narrative of, volume growth, and the successful execution of their divestiture-funded debt reduction. They were completely overlooking the structural declines in the raw GAAP numbers and the margins.
Okay, so that's the perfect place to start then. Let's get into those financial highlights and really the comparability issues.
To understand why the stock rallied despite that sales decline, we have to look at the GAAP results versus the operational reality.
Okay.
Net sales fell from about $2.79 billion in Q1 25 to $2.63 billion in Q1 26. But, and this is the big but, if you strip out the impacts of their massive divestiture program,
the sales of Chef Boyardee and the frozen fish businesses.
Exactly. If you take those out, the organic net sales figure was $2.611 billion, and that represents only a 0.6% decline year over year.
So almost flat, really.
Almost flat. That divestiture activity, which was part of their portfolio evolution strategy, that's what heavily impacted the reported top-line figure.
Okay, that immediately clarifies the sales picture. The drop was driven by them choosing to exit parts of their portfolio, not, core consumer rejection.
Right.
But here's where the operational pain point really hit. Regardless of accounting adjustments, further down the income statement, we saw gross profit just drop sharply from $739 million last year to $640 million this quarter.
A huge drop.
A huge drop. And similarly, operating profit declined from $401 million to $347 million. These are substantial, tangible drops that reflect real-world cost pressures.
Absolutely. The margin contraction is undeniable, and frankly, it's the biggest operational concern in the quarter. The adjusted gross margin declined by a staggering 153 basis points. It settled at 24.4%. And the adjusted operating margin saw an even steeper decline. It was down 244 basis points, finishing at 11.8%.
Over 2 full percentage points of margin just gone.
Gone. And this margin pressure is the core cost of the strategy management is executing. It's driven by these relentless inflation pressures and what we call unfavorable operating leverage, particularly in the refrigerated and frozen segments. They are deliberately, consciously prioritizing volume over pricing, and this is the direct quantifiable cost of that choice.
Okay, let's unpack the difference then between GAAP and adjusted EPS, because
Yeah.
this is where the waters get truly muddy and where I think most casual observers miss the full story.
Mm-hmm.
The raw GAAP diluted EPS comparison is it's utterly jarring. 34 cents this quarter versus a whopping 97 cents in the prior year period.
Night and day.
You cannot possibly compare those two numbers without diving deep into the items impacting comparability. This is where we see 2 years of these extraordinary non-operational events just clashing with each other.
That's spot on. For Q1 of fiscal 26, the biggest adjustments revolved around the financial closing of those divestitures. They reported an accounting net gain of $42.4 million associated with the sale of the Chef Boyardee and the frozen fish businesses.
Okay, so a gain. Sounds good.
It sounds good. But now here is the technical complexity. Despite booking a gain on the sale, due to non-deductible goodwill impacting the tax rate associated with those legacy assets, this gain actually resulted in a significant after-tax loss of $20.4 million.
Wait, I have to stop you there because for many listeners, that sounds like pure accounting magic. How do you sell a business, book a gain, and then have a loss because of the tax rate? Can you simplify what non-deductible goodwill actually means in this context?
Yeah, it's a great question, and it's essential for understanding the tax rate shock we're about to talk about. So when Conagra acquired certain businesses, like the assets that carried the Chef Boyardee brand years and years ago, they put a value on the intangible assets, the goodwill.
Right, the brand name, the customer loyalty, all that stuff.
Exactly. That goodwill represented the premium they paid over the tangible assets, like factories and inventory. Now, crucially, U.S. tax law often stipulates that this legacy goodwill, especially when it's related to older acquisitions, is not tax deductible when the asset is sold.
I see.
So even if the cash transaction is profitable, the IRS says you can't write off that portion of the old purchase price, the goodwill, against the cash proceeds you just received. This creates a massive one-time spike in taxable income for accounting purposes, and that results in a huge tax expense, $62.8 million in this case, that drives the GAAP net income down sharply.
That makes perfect sense. It's the legacy accounting baggage hitting them right as they're trying to clean up the portfolio. So now, let's look backward. The prior year period, Q1 of FY2025, was skewed in the opposite direction, which just complicates the comparison even more.
Yeah.
It included an enormous income tax benefit of $211.4 million.
Just a monster number.
It was related to the release of valuation allowances on deferred tax assets. That single item drastically inflated the GAAP net income last year, alongside a smaller but still significant gain of $17 million from fire insurance proceeds.
Exactly. So when you normalize for these two extreme figures, the prior year's massive tax benefit and this year's massive divestiture tax hit, you finally arrive at the true operational bottom line. And that is why the adjusted EPS beat of 39 cents was the number the market focused on.
The resulting effective tax rate story it's truly one for the history books. For Q1 FY2026, the effective tax rate soared to 43.1%.
43%. For a food company, it's wild.
It's insane. And that was almost entirely due to the divestiture cleanup, negatively impacted by that $62.8 million of tax expense from the non-deductible goodwill on the sales of Chef Boyardee and Van de Kamp's.
Right.
And on top of that, they also incurred an additional $5.5 million in tax expense related to stock-based compensation, which happens when the stock price declines. It just further illustrates the quarter's complexity.
And that 43.1% tax rate needs to be contrasted with the prior year's rate, a staggering negative 42.4%.
A negative rate. They were getting money back, effectively.
A massive negative rate. It was entirely due to benefiting from that $210.4 million deferred tax benefit we mentioned. It just highlights why looking solely at GAAP income taxes year over year is completely meaningless and why analysts have to rely so heavily on the adjusted figures this time around.
Before we leave the tax section, you mentioned a minor but interesting piece of new legislation, the One Big Beautiful Bill Act, Public Law Number 11921, enacted on July 4, 2025. What's the practical implication here for them?
Well, it's a nice win for liquidity, even if it doesn't solve this ETR volatility.
Right.
The Act allows for accelerated tax deductions specifically for things like qualified property and research expenditures.
Okay, so they can write things off faster.
Exactly. Management confirmed they expect this provision to provide a beneficial cash flow impact in FY 2026. This means they will pay less tax cash this year because they can write off capital expenses faster.
But not on the income statement.
Correct. From a GAAP accounting perspective, because of how deferred tax liabilities are calculated, it doesn't materially affect the reported effective tax rate calculation for the income statement. So it's a great piece of news for debt reduction and cash management, but it doesn't fix the income statement mess.
So if we step back from this first section, the key takeaway is GAAP looks absolutely disastrous due to the timing of two massive non-recurring tax items separated by 12 months.
Right. It's all noise.
But the operational metrics show real, undeniable margin erosion over 200 basis points in operating margin, which is the calculated cost of their segment-specific strategy. So let's dive into that strategy now.
Let's do it.
Moving into the 4 business segments, this is where management's horses for courses strategy plays out perfectly. They are explicitly following 2 very different strategic tracks.
Very different.
On one track, they are heavily investing in volume growth for key segments like refrigerated and frozen and snacks, which represent about, 70% of their total retail business. This means sacrificing margin.
It does. They're paying for that volume.
And then on the other track, they are maximizing cash flow in their stable segments, primarily through inflation-justified pricing, where the elasticity allows for it.
Starting with grocery and snacks, the reported net sales declined significantly to about $1.08 billion. That's down a sharp 8.7% year over year.
Get a scary headline number.
A very scary number. But as we established, the divestiture impact was huge. The organic performance for the remaining business was down only 1.0%.
Okay.
And digging into that small organic decline, volume dropped 1.6%, which was partially offset by a price mix increase of 0.6%. So while consumers pulled back slightly on volume, they did successfully push some pricing through, primarily to cover their input costs.
And the divestiture impact here is worth dwelling on just to show how much cleaner the portfolio will look going forward. The divested Chef Boyardee business contributed a steep $110.1 million in sales in Q1 of 25. But only $7 million in Q1 of 26 before its sale was finalized. That $103 million difference explains almost the entire reported sales drop for the segment.
And the profitability suffered significantly because of that portfolio shrinkage. Segment operating profit for grocery and snacks was $220.8 million, a sharp decline of 12.9%.
Wow.
This decrease was primarily driven by the lower overall net sales, persistent input cost inflation, and the clear loss of profit associated with the divested Chef Boyardee business. It's a deliberate trade-off. They're shrinking the base to grow higher margin, higher growth snacks later.
So they're taking the pain now.
They are. And we should also note a bright spot. This segment included a small inorganic size boost of $10.6 million in Q1 26 from the acquisitions of Sweetwood Smoke & Co., that's the popular FAT meat sticks, and a contract manufacturer, which signals where their future growth is going to come from.
Okay, let's move to refrigerated and frozen, or R&F. If grocery and snacks was about cleanup, R&F is about strategic pain. This segment is the one that really got hit hardest in terms of bottom-line profitability.
It really is the battleground for them right now.
Reported net sales were $1.076 billion, down just 0.9%. Organically, the segment was slightly positive, up 0.2%. And this is exactly what management wanted. Volume rose 0.5%, showing that consumer pool is starting to stabilize.
But look at the cost of that volume growth. Price mix fell 0.3%. That negative price mix is the clearest reflection of their strategy. They are prioritizing volume over raising prices to match the current intense inflation environment, especially in animal proteins. They are making a calculated bet that securing that shelf space and consumer loyalty now will pay off with huge margin flow-through when inflation eventually, hopefully, moderates.
And that sacrifice translated directly into profit pain, which makes this segment to watch. Segment operating profit plunged a devastating 28.1% to just $114.4 million.
0.8%. It's just a huge hit.
Yeah. This massive decline was driven by heavy input cost inflation, that unfavorable operating leverage you mentioned, meaning their fixed manufacturing costs were absorbed over fewer units than optimal. And of course, the profit loss from the frozen fish business divestiture, Van de Kamp's and Mrs. Paul's.
Management also provided a specific point on comparability that helps us understand the baseline. They estimated that Q1 of 25 gross profits were negatively impacted by approximately $10 million.
Okay.
And that was due to temporary manufacturing disruptions related to the Hebrew national brand during the key grilling season last year. So Q1 25 profit was already suppressed, which actually makes the 28.1% plunge this year look even more severe than if the prior year had been a totally clean base. That $10 million is a huge specific number impacting the year-over-year narrative.
And we mentioned the smaller divestiture here.
Yeah.
The frozen fish business contributed $17.4 million in Q1 25, falling to just $4.9 million in Q1 26 before its sale. But the biggest lingering factor here is qualitative.
It is.
Management noted that the R&F segment is under pressure due to weak consumer sentiment and macroeconomic uncertainties. And that poses a potential future risk for goodwill impairment.
And that risk is enormous. You have to understand the scale here. The R&F goodwill balance is $4.916 billion.
Almost $5 billion.
It's almost $5 billion, and that's net of accumulated impairment losses of almost $670 million. So if this profit weakness persists, if the stock price decline continues, and if management's expectation for a cyclical volume rebound doesn't materialize, that impairment risk is very real, and it would change the entire structural narrative of the company from a cyclical recovery story to one where they simply overpaid for brands.
That's the bear case right there.
It is. It underscores the high stakes of their current volume-focused strategy.
Okay, well, let's turn to international, which is a minor part of the overall story. It accounts for less than 10% of total revenue. But reported net sales dropped significantly, down 18% to $212 million. Again, mostly divestiture-driven.
Yes, the organic decline was much smaller, at 3.5%. Volume fell by 5.2%, which is a bit of a concern, but price mix increased by 1.7%, showing pricing power is still available internationally.
Okay.
Foreign exchange also worked against them. It was unfavorable by 1.3%, primarily due to the strength of the US dollar relative to the Mexican peso. The major sales comparison issue is that Q1 of 25 included $23.6 million from Agrotech Foods Limited, or ATFL, which was sold earlier in Q1 25.
Now, despite that dramatic sales drop in the ATFL sale, operating profit surprisingly rose 5.3% to $37.7 million. That's a huge divergence. How did they manage to boost profit while sales plummeted like that?
This is a classic example of operational discipline trumping volume decline. It was driven by strong cost control, specifically lower SG&A expenses, and favorable foreign exchange rates on certain local costs that offset the gross profit reduction from the ATFL sale and the input cost inflation. They just managed the levers they could control very, very tightly, leading to a much better bottom line despite the shrinking top line.
Excellent execution there. Finally, we have food service. Reported net sales were essentially flat, down 0.8% to $264.5 million. Organically, sales were up slightly by 0.2%. Price mix was robust, rising 3.8%, which is excellent. But this was unfortunately counteracted by a volume decline of 3.6%.
And the volume drop was attributed by management to ongoing soft yet stabilizing trends in commercial traffic.
Yeah.
Essentially, the number of people eating out just hasn't fully rebounded to previous levels.
Right.
And similar to R&F, the segment saw profit pressure. Segment operating profit dropped 21.1% to $27.7 million, due primarily to input cost inflation and that unfavorable operating leverage. It's also important to note that the Hebrew national manufacturing disruptions also impacted food service, estimated at about a $3 million sales loss last year, which again makes the current performance look a little weaker in comparison.
So across the board, the story is sales declines are largely explained by divestitures, but the margin erosion is real. And in the case of R&F, their growth engine, it's strategic.
That's the perfect summary.
Which leads us directly to the cost structure they are fighting against. Let's get into the details of that.
All right.
Now we transition from the segment performance to the underlying structural realities: inflation, cost, and cash flow. Management was very clear about the continuing aggressive inflationary environment. They reaffirmed their FY 2026 inflation guidance at approximately 7% overall.
7% is an enormous headwind for a staples company. I mean, just enormous. And that 7% is broken down into 4% core inflation on general ingredients and manufacturing costs, and 3% gross tariffs, primarily on imported items like canned goods.
Okay, and how much can they fight back against that?
They expect their productivity initiatives, so, efficiency gains, sourcing optimization, to mitigate about 5.5% of that total inflation figure. That leaves a 1.5% gap that they must either cover with pricing or, more likely, absorb into their margins, which is exactly what we saw happen in Q1.
And the pressure points are acutely specific and historically high.
Yep.
Management highlighted double-digit core inflation in the overall animal protein basket.
Yeah, that's the real killer right now.
Main means beef, pork, and turkey are sharply up, while only chicken is moderating. This is where the headline comes in. Beef, in particular, is at historic highs due to supply lows not seen since the 1950s.
That historical context is critical. Think about the strain that puts on a company that relies so heavily on meat products, especially when they are actively choosing not to raise prices in their R&F segment to protect volume. That exposure to beef supply lows from the 1950s, driven by herd size constraints, is completely unique and volatile. And management has a very limited ability to hedge against it because it's a structural supply issue, not just a commodity pricing fluctuation.
Right. You can't just buy a futures contract for cows that don't exist yet.
Exactly.
Regarding their commodity coverage, management is about 85% covered on commodity costs for Q2, which provides decent visibility in the near term. But that coverage drops substantially to only 60% to 65% for the full year.
Right, so there's a lot of exposure in the back half.
A lot. And this leaves them significantly exposed to future price changes, particularly in animal proteins, which, as you noted, are largely purchased on the spot market. They also expect the tariffs on canned goods to continue, confirming that the 3% gross tariff estimate remains unchanged for the foreseeable future.
Now let's look at operating expenses. SG&A expenses were nearly flat year over year. They totaled $335.6 million for Q1 '26, which is an increase of just $0.2 million from Q1 '25. This shows really tight control on corporate overhead.
But within that stability, there were some underlying shifts. SG&A included restructuring charges of $3.7 million, an increase in short-term incentive expense of $9.3 million, which suggests maybe they are confident they will hit their targets this year.
That's an interesting tell.
It is. And an increase in salary and wage expense of $5.2 million. These costs were largely offset by two positive items: a gain of $5.4 million from the sale of corporate land and a decrease of $4.8 million in consulting fees. It's the story of lean management, selling non-core assets to fund necessary internal reinvestment.
Now for a crucial look at cash flow, which is where the divestiture benefits became immediately clear. Net cash from operations fell sharply to $120.6 million in Q1 '26, down from $268.6 million in Q1 '25.
Wow, that's a massive drop in operational cash generation.
It is, but there is a clear strategic reason for it.
Yes, the primary driver for that decline was the necessity to rebuild inventory. Management executed a significant build in inventories, which amounted to a $207.4 million use of cash in the quarter.
And you should think of this as management finally paying up to refill the pantry after years of rationing. Last year, they suffered supply disruptions, which hurt their ability to serve customers, dropping service levels below acceptable standards. This $207 million cash investment was made to restore service levels, which are now back to 98%.
Which is table stakes, really. You have to be at that level.
You have to be. This investment is crucial to ensure they can meet upcoming consumer demand, especially as they ramp up promotional activity in the second half. It was a planned, necessary use of capital.
On the investing side, this is where the divestitures shine. Cash from investing activities showed a substantial inflow of $502 million in Q1 '26.
A huge number.
This was driven primarily by the colossal $643.6 million in proceeds from the divestiture of the Chef Boyardee and frozen fish businesses. This inflow was partially offset by routine capital expenditures of $146.8 million.
And that brings us to their future investment plans. Management forecasts full-year FY2026 CapEx at $450 million. That represents a substantial 16% increase year over year.
And where's that money going?
This capital is heavily prioritized towards supply chain resiliency and modernization investments. They specifically cited modernization of key facilities, like their chicken plants, which ties directly into the volume inflection story we'll discuss next.
This liquidity boost allowed for aggressive debt management, which was clearly the #1 financial priority for Q1.
Absolutely, no question. They issued $1 billion in new senior notes, split between 5% notes due 2030 and 5.75% notes due 2035. And they immediately used a significant portion of the divestiture proceeds and the new note issuance to prepay $500 million in existing term loans.
Which ones did they target?
They went after the near-term stuff. Specifically the $200 million 2025 term loan and the $300 million 2024 term loan. This focus on cleaning up the near-term maturity runway is already bearing fruit.
So how does that impact their expenses immediately?
Net interest expense decreased to $93.8 million in Q1 '26, down significantly from $105.8 million in Q1 '25.
That's a $12 million reduction in one quarter.
It is a $12 million reduction per quarter driven entirely by reduced debt balances and favorable refinancing rates. Their weighted average coupon interest rate on long-term debt is now approximately 4.9%. This move frees up significant future operating cash that can be reinvested or used for shareholder returns down the road.
And they also proactively addressed their liquidity cushion, right? They put in place a new $2 billion revolving credit facility maturing in June 2030.
With zero outstanding borrowings as of August 24th, 2025. That gives them tremendous flexibility.
It does?
And their debt targets remain firmly in sight. They reiterated a commitment to pay down another $700 million in debt for FY 2026. This is building on the $1.1 billion they paid down in the previous 12 months.
So they're serious about this.
They are very serious. And crucially for investors, they confirmed compliance with all debt covenants. They're maintaining the EBITDA to interest ratio above the minimum 3.0 to 1.00 and the funded net debt to EBITDA ratio well below the maximum 4.5 to 1.00. They are laser focused on deleveraging.
Finally, let's touch on shareholder returns. The quarterly cash dividend remains steady at 35 cents per share. Given the stock price pressures, the forward dividend yield is currently sitting over 8%.
Which is extremely attractive for income investors.
Extremely attractive. But it's important to note the strategy here. CAG has not raised its dividend since 2023, and their preference for debt reduction over stock buybacks is crystal clear. They repurchased only 0.8 million shares for $15 million in Q1 '26.
Barely anything.
Barely anything. While they retain a substantial remaining authorization of $837 million, management explicitly stated they are prioritizing debt reduction over opportunistic share repurchase at this time. Their capital allocation playbook is crystal clear. Divestitures fund debt reduction and investment in the supply chain funds future volume growth.
Okay, so this brings us to the core investment question, the one that really drives the stock price from here. Is the current volume weakness structural, or is it merely cyclical? And management addressed this directly. They argued strongly that the vast majority of these behavior shifts, like the flight to cheaper private label brands and this intense value-seeking behavior, are cyclical and transitory.
And they grounded this belief in a staggering statistic. They said these behaviors are a direct result of the cumulative 40 to 45% cost of goods inflation experienced by the consumer over the last 5 to 6 years.
40 to 45%. That cumulative inflation is the single most important context for understanding the consumer right now. It means household budgets are completely strained, forcing consumers to make choices they would ideally prefer not to make. Management believes that once household finances stabilize, consumers will return to the familiar, established brands. And that justifies their decision to preserve brand loyalty by investing in volume now.
However, they did acknowledge that some true structural shifts are occurring, which is where they're focusing their innovation.
Well, it's not all cyclical.
These are fundamental changes in consumer preferences related to health and wellness, such as, less alcohol, less sugar, or less carb consumption. They cited this structural trend as specifically benefiting their seeds and their protein snacks, businesses like Slim Jim and Fati.
They also noted a persistent channel shift. The pursuit of value drives consumers back to large format retailers, club stores, and hard discounters. And this requires innovation and agility tailored for those specific channels. For example, brands must ensure their packaging and their pricing meet the needs of a Costco shopper versus a convenience store shopper. If you can't win in the club channel, you lose a massive volume opportunity in this environment.
Okay, this leads us to the expected volume inflection point. Management is guiding the street toward positive organic sales growth in the second half of FY 2026. What exactly are the drivers for this crucial turnaround?
Well, there are three main levers. First, they benefit from easy year-ago comparisons, especially in the frozen segment, due to lapping last year's severe supply constraints.
Right, it's easy to grow when last year's number was bad.
It's much easier to show volume growth when last year's base was artificially depressed because you couldn't even keep products on the shelf.
Second, innovation and investment are expected to deliver strong consumer pull. This includes new, premium-priced products like the Dolly Parton frozen meals.
Which is an interesting launch.
It is. Management sees these high-profile premium launches as a way to prove elasticity exists at the higher end of their portfolio. And crucially, we see the continued success of protein snacks like Slim Jim and F80 smoked meat sticks. The F80 line specifically is growing at close to 100% year over year.
100%. That's a genuine growth engine they are aggressively funding.
It really is.
And third, operational improvements are kicking in, which links back to their CapEx strategy. The baked chicken facility modernization is expected to be completed in Q2 '26, followed by the fried chicken modernization. This is a process of what they call repatriation of outsourced production.
So bringing manufacturing back in-house.
Exactly. And why is this crucial? It leads to lower costs, better quality control, and most importantly, improved margin absorption, a key benefit management emphasized for potential FY 2027 margin flowback. When they run their own efficient plants at high utilization rates, the fixed costs are spread over more units, and that boosts margins significantly.
Now, when looking at the Q2 outlook, management did temper expectations a little bit. They expect continued soft consumption trends with volume declines similar to Q1.
Right.
They also noted that major frozen merchandising events are planned later in Q2 of 26 compared to Q2 of 25, which affects the short-term sales cadence and will likely suppress the Q2 volume numbers slightly compared to the prior year.
And the promotional environment remains rational, which is a key stability metric for the industry. Promotional levels, so the volume sold on deal, are generally near pre-COVID levels. Management confirmed they have not observed a push toward deeper discounts across the competitive landscape.
Which is good to hear.
It is. And elasticities, particularly for price increases on staples, remain generally predictable. They are hovering around a -1.
Let's clarify that for the listener. What does an elasticity of -1 tell us about the consumer right now?
Well, it's good news, relatively speaking. An elasticity of -1 means that for every 1% price increase they implement, they lose about 1% in volume.
Okay, so it's proportional.
It's proportional, predictable, and controllable. The key point is that we haven't seen a cascade into hyperelasticity, where a 1% price increase causes a 3 or 4% volume loss, which would signal that brand loyalty has completely broken down. The consumer is price sensitive, but the brands still matter enough for the losses to be proportional.
We should also discuss the long-term portfolio evolution and their M&A philosophy. Over time, the strategic goal is explicitly for a meaningfully larger chunk of total portfolio sales to be focused in frozen and snacks.
Right.
And by definition, this means the legacy grocery business will naturally decline in relative terms, as we saw with the divestitures of Chef Boyardee and the frozen fish brands.
And they also address their strategic holding, Ardent Mills, which is a joint venture with Cargill and CHS. It's viewed as a good performer and a hedge during volatile times, generating strong free cash flow from the flour milling business.
But it's not a branded product.
It's not, and that's why management remains open-minded about its future role, given it differs so starkly from the branded core business. This is corporate speak for, if the right opportunity arises, we would consider monetizing this asset to further fund branded growth or debt reduction. They are constantly pruning non-core assets.
To close out the forward view, management emphatically reaffirmed the full-year targets for FY 2026, which gives the street confidence in their narrative.
Yes, the numbers stand firm despite the messy start to the year. Organic net sales growth is projected between -1% to +1%.
Pretty tight range.
Very tight. Adjusted operating margin is targeted at 11.0% to 11.5%, and adjusted EPS is guided between $1.70 to $1.85.
And what's Wall Street thinking for next year?
Critically, Wall Street analysts are already looking ahead. They're forecasting $1.87 in diluted EPS for FY 2027. If they hit that mark, it represents a potential 6% increase and the long-awaited resumption of bottom-line growth, justifying all the strategic decisions they made in Q1.
One final critical risk note that must be repeated for the 10Q filing. There is the explicit risk of material goodwill or intangible asset impairment in the refrigerated and frozen and food service reporting units if the current weakness and the stock price decline is sustained.
Right.
That $4.9 billion goodwill balance in R&S is definitely one to watch, and management needs that volume inflection point to happen fast to protect it.
That risk underscores the urgency of their strategy. They are trading margin now for volume recovery later. Failure to execute that recovery means that cyclical pain becomes permanent impairment.
A very high-stakes game.
To summarize the critical financial synthesis of this quarter, this was a cleaning up quarter. Despite the huge JAP declines and the volatile effective tax rates driven by legacy accounting, the adjusted EPS showed resilience by beating estimates. Crucially, the massive debt reduction and capital restructuring funded by the divestitures are firmly on track. That's reducing their interest burden and strengthening the balance sheet. However, the operational challenge remains balancing the core inflation and tariffs, that persistent 7% overall headwind, against their long-term goal of driving volume and securing market position in the high-growth frozen and snacks categories.
And that leads to the critical factor you need to monitor for the rest of the year, the strategic tension of price versus volume in R&F. Management is consciously sacrificing that 244 basis points of short-term margin to secure future consumer pull. The big question for FY 2027 is, what margin flowback will occur if animal protein inflation eases? If they get commodity relief and they don't have to roll prices back immediately because they strategically held prices stable during the worst of the inflation, that margin capture will be the defining factor in their financial rebound and the true test of this calculated risk. With that, we conclude our coverage for this video. Thanks for joining us. Sheen Research. Mindful markets, measurable meaning.